Hello and welcome to People and Profit, where we look at how business shapes our world. I'm Stephen Carroll. Coming up, are Europe's banks heading for another crisis? Thousands more job losses are announced as lenders tighten their belts. Third time lucky, we're asking if Google's new smartphone will make a mark in an already crowded industry. And it's not just for show. We're going back to the Paris Motor Show to see how car buyers are driving hard bargains on the latest models. First up, though, it's been another rough few weeks for Europe's banks. Fears over the financial health of Germany's biggest lender, Deutsche Bank, sparked a sell-off of bank shares. European lenders are struggling to maintain profits as interest rates are at record lows. In a moment, we'll be discussing the state of the sector with the ratings agency Standard & Poor's. But first, faced with lower earnings, banks have been cutting costs, slashing tens of thousands of jobs in the process. Josh Vardy has the story.
Union protests at the shock announcement from ING. The Dutch lender is cutting 7,000 jobs, around 12% of its workforce, in order to save €900 million a year by 2021. The bank is closing branches and instead focusing its business online.
The customer asking from us more digital when he wants it at any time, anywhere, and on the other hand, more advice and availability of our people. So we transform the bank in a fundamental way to be ready for the future.
The cuts are the heaviest job losses at the firm since the bank was bailed out in 2009. ING's announcement comes a week after Germany's Commerzbank announced 9,000 of its jobs are to go. Spain's Banco Popular has also recently promised to shed up to 3,000, joining Lloyds, UniCredit and Deutsche Bank in a pan-European bloodletting that has picked up steam over the past year. The cuts reflect lower bank profits in general, a situation caused by low interest rates across the Eurozone and tighter financial rules mixed with a sluggish global economy.
We don't have a banking crisis. We have a profitability crisis in our banks. Cost-income ratios are too high. The margins are very bad due to the dramatic interest rate situation. The banks will have to tackle those challenges and reorganize.
With the potential for boosting earnings limited by interest rates that are close to zero, reorganizing means cutting more costs. Since the start of 2015, European lenders have cut more than 100,000 jobs worldwide.
Well, for more on this story, let's speak to Osman Sattar, who's a director at the financial services team of the ratings agency Standard & Poor's. Osman, thanks for joining us from London. Deutsche Bank we've been hearing a lot about in recent days, but there are concerns about a lot of Europe's banks. What is your assessment of the state of the sector at the moment?
Well, I think the sector's going through kind of a long-term change in what it's doing since the financial crisis. So there's a significant restructuring going on across a number of European banks. Perhaps Deutsche Bank is one of the worst affected, given that it's got a litigation is higher than expected. It's a little bit behind where it wants to be in terms of its restructuring. So really, we're in a period of transition between what we had pre-crisis and what banks are trying to get to in the new world that we're in.
We've come a long way since the height of the Eurozone crisis and the concern around banks at that stage. At this stage, how safe are Europe's banks?
I'm not sure if it's a question of safety, but more of profitability, because if I look at the balance sheet strengthening that European banks have done since the crisis, they are in line with global peers. So we have stronger balance sheets and stronger capital. Now the question is more about business models and ongoing profitability and how to achieve ongoing profitability in a European environment of low growth and negative interest rates. And that is a challenge, and it remains to be seen which banks do better than others in meeting that challenge.
So when we hear things like announcements of massive job losses, thousands of jobs being cut, really that's a positive sign in terms of stability of the bank because they're doing something about it.
Yeah, so you may have seen that ING had an announcement of job losses and Commerzbank had an announcement of job losses. These are banks that are, as I mentioned earlier, trying to transform their business models, become more regular banks with utility banking and have better cost-to-efficiency ratios. So reduce the branch network, move on to more online banking, as the Nordic banks have done. So from a pure bank perspective, those job losses are a good thing, but clearly for the wider economy and for the people affected, it's a different story.
Are we seeing effects of the safeguards that have been put in place since the Eurozone crisis in terms of increased equity reserves and the amount of money that banks are holding in safe terms? Is that hurting banks as well now?
I think there is an argument to be made that capital requirements and those reserves that you spoke about are at a level where, you know, a significant further increase wouldn't be of much benefit, and the downsides could outweigh it. But in terms of where they are today, I think they're in the right place with regard to capital rules. I don't think that's been a particular constraint. I think you could argue that those capital requirements have helped banks to strengthen their balance sheets and finance themselves more at a lower cost than otherwise would be the case.
And when you look across Europe, are there still weak spots? Italy, for example, there have been troubles with recently. Are there certain sectors or certain countries that you look at as being where their banks are perhaps less stable?
Well, you know, the crisis particularly affected the periphery, but since then, I think, you know, we've seen quite strong recoveries in Italian in Irish and Spanish banks. Whereas with Italy and Greek banks, there are still some difficulties with high levels of NPLs. And with the introduction of the banking BRRD, the resolution restrictions, it's more difficult for governments to be able to step in and provide support to banks, which means that, you know, the actions that the Irish and Spanish governments took to help their banks is more difficult now for Italian banks for Italian government to undertake. That said, you know, it doesn't completely preclude solutions, and you will have seen that at the moment Italian banks are required to offload certain amounts of NPLs to the GAC with some element of government support, in the sense that the higher tranches of the issue are underwritten by the government.
OK, and those are issues we'll continue to watch closely. Asim Sattar from Standard & Poor's, thank you for joining us from London.
Thank you.
Now next to Google's latest attempt to become a major smartphone manufacturer. With the Pixel, it hopes to rival industry leaders with a voice-activated assistant, high-quality camera and longer battery life. It's the third time that Google has tried to break into this market. Pixel replaces the Nexus, which, while popular with developers, never scored massive sales. Google didn't have much success with Motorola either, which it sold on after just 3 years. This time around, though, the company thinks it's gotten it right.
While Pixel's beautiful, what really makes it come to life is how the hardware and software work together. It's the perfect example of how the best of Google Smarts combines to make a great, simple user experience.
So, is there room for Google in the market? Kate Moody's been finding out. Kate.
Well, Stephen, the global smartphone industry is valued at $400 billion. Samsung models are the best sellers in the world. The South Korean giant claimed a 22% share worldwide in the second quarter of 2016. Apple has the next biggest slice of the pie with nearly 12%. They're followed by 3 Chinese tech companies, Huawei, Oppo, and Vivo, with 21% between them. Smaller providers make up the remaining half of the market. Smartphone sales have exploded over the past decade, with 1.4 billion handsets sold in 2015. That's the slowest growth rate since 2008. Analysts say the market is quickly becoming saturated, though there may still be room for growth in emerging economies like China, India, and Brazil. With the Pixel, Google is taking a deeper plunge into a rapidly changing landscape. One-time market leader BlackBerry recently announced that it would stop designing its own handsets. Apple's latest iPhone failed to impress with fewer innovations than previous designs. And Samsung has faced an exploding headache, forced to recall its latest Galaxy Note 7 because some batteries burst into flames. Now, Google has already tried and failed to make its mark as a major smartphone maker. It's not alone, because well-known companies like Dell, Microsoft, and Nokia have all launched and withdrawn smartphones that didn't catch on. So why might the Pixel be a game changer? There's the advantage of name recognition of the world's biggest search engine. Google's operating system, Android, is already used on over 80% of smartphones, which makes the platform familiar. The Pixel is also designed to be compatible with other Google products in the hope that it might give the newcomer an edge over its rivals. Stephen?
Kate, thank you very much for that. Now, the Paris Motor Show is open to the public and over 1 million visitors are expected through its doors by October 16th. It's not just petrol heads who'll be checking it out, though. Car buyers also use the show as an opportunity to drive a hard bargain on the latest models. Shar Palagan reports.
It's more glamorous than the usual dealership, but how many of the visitors at the Paris Motor Show actually end up buying? The answer can probably be found behind the Renault booth. In this room, where 50 sales staff and 20 lenders court potential clients, and where a car is set to be sold every 10 minutes. And for those who seal a deal, there's champagne to celebrate. Though these clients are tight-lipped about the discount they received.
The exact price? I'm not sure.
A very good price. At a car show, the goal is to make the best offer possible.
Other potential buyers get a chance to test drive cars they're considering buying.
It's nice to have a vehicle that's kind of a 4x4. Before testing it, it's difficult to know what it would be like. But when you test drive it, it can be a decisive factor.
But in the end, Gregory decided to take time to think about it. Unlike Hadifa, who made up her mind about this Nissan electric car she tried out.
You can locate the most convenient charging points on the itinerary you selected.
She sits down with the salesman, hoping to get a good price.
I told myself we'd get a special offer, and we did. I'd like 15 to 20% less, but we're not far off.
Attractive prices, a strong sales pitch, and a short stint behind the wheel. For constructors, the Paris Motor Show is a big opportunity to convert some of the expected 1 million visitors over 2 weeks into customers.
That's it for this People in Profit. If you have any questions or comments on the stories that we've been covering, get in touch on Facebook at France 24 Business, or you can tweet me at NewsStephen. Until next time, thanks for watching.